When I hear passive investing, I just kind of cringe a little bit. If you're an investor, there's nothing passive about it. You need to be watching your investment. It
The
sounds like
granularity and the size and the volume of the strategy, it's easy for it to eat you if it's not something.
so. What are you most excited about with the investment in strip centers? Thank you for coming on today. I've been wanting to talk about strip centers for a while because it's been a pretty hot topic. And why don't you give us a little bit of background on yourself?
Sure. I'll keep it to the recent past, but have been in real estate my entire career, over 20 years. But had the fortune of in 2012 joining one of the epic operating platforms in retail, specifically grocery, and Phillips Edison, and was a part of a great team that was able to scale appropriately, produce an amazing track record and return profile for investors. I got to learn from one of the best operating platforms, and during all of that, was able to see really what we saw today, or what we saw in 2019 when we launched Last Mile, which was the strength of this shop space, and the secular fundamentals that caused us to form Last Mile Investments to dedicate kind of an entire platform to it.
Okay. Now you've done over 10 billion in transactions, correct?
Correct. On the debt, equity, M&A, joint venture, all wrapped in.
All right, you're in 18 markets right now. By 2025, you want to be in at least 25 markets. So you got some growth you're working on.
We do. We think there is a real benefit to scale in this strategy. Right. We also think there's a real benefit to the granular nature of the asset class, right? So not only do you have granularity and diversity in your tenant base, there is no one tenant, driving your results that you're exposed to, but the ability to produce a national portfolio that gives you exposure to, diverse exposure. So that same granularity at the asset and market level that we get at the rent roll.
Okay. Now you focus on unanchored centers, correct?
Correct.
Okay. Why unanchored?
Historically, there was incredible strength within grocery anchored real estate. And that only was exacerbated during COVID, right? People even loved grocery even more, and deservedly so. Grocery became priced like it, though. Obviously, when you think institutionally, there wasn't a fund flow that wasn't focused on it. But we were seeing that the retailers wanted to be near the grocery stores, and we started actually seeing that the retailers wanted to be in places as long as they were nearby, right, where that traffic was being generated, didn't necessarily need to be attached to the grocery store. And so we saw this small little asset class, that little 4 to 8 tenant center that no one was paying any attention to, other than the fact that you were going there to get your nails done, going there to get your hair done, going there for your fitness, and increasingly you're going there for your medical needs, your optical needs, your dental needs. But it was so small and so innocuous that no one was paying any attention to it, that it felt a bit mispriced. It felt misunderstood because it was unanchored, this negative connotation, which we actually wish it was still called that so people stayed away. But it was also an asset class that was, I hesitate to say mismanaged, but typically owned by individuals that are really managing it more for cash flow than value creation. Meaning that they really value keeping their tenants in at a low rent and keeping the cash flow coming in the door, versus maybe understanding it's in Raleigh, North Carolina, where growth has gone through the roof, including, rental rates, and there may be an opportunity for a win-win between the retailer and the landlord to increase rents, keep their occupancy costs healthy as well, but you can be moving those rents with what's going on in the market.
Right. Now, do you guys focus on stabilized or value add strip centers?
We focus on both. There's very little we acquire that we believe there isn't something we can do with. So it may look stable, but we believe the rents are under market, and it may just be a patient play of a $22 center that we think should get 30. When are we going to get to those rents? We could be patient around that. And then there's obviously value add strategies we've created where there's light refreshes to major refreshes of the center that then come with kind of more advanced merchandising strategies.
Okay. Yeah, it's unit mix is kind of an art form, right? So what are your metrics on unit mix in your centers?
I don't know if there's an exact formula.
Okay.
We often actually see a tremendous amount of redundancy, meaning that there wasn't an exclusive, so they put two of one use in a center that made very little sense. We actually also see a lot of conflicting, right? A
Yeah.
smoke shop next to the smoothie shop, right? And so we do like there being a certain amount of F&B, a certain amount of medical, a certain amount of service, and a certain amount of wellness, to the extent that we can get someone from each of those categories, which are the main categories that represent kind of our portfolio.
Okay. What is the typical size of your centers? You said 4 to 8 is your sweet spot?
No, I mean, that's probably on the smaller side.
Okay.
Today I would say our average center is right around 30,000 square feet.
Okay.
And our average unit size, or average tenants, 2,200 square feet.
Okay.
So, we're running somewhere around 13-ish tenants plus or minus on average.
Okay. Do you have what's your mix of national credit tenants to local operators?
Yes. I would say we're close to 75-25. When you
75
count,
national or 75 local?
I would say we're 75% national, but that
Oh.
includes what a lot of people like to call local. And so what we're including is that Jersey Mike's franchisee that has 20 units, right? He's an operator. He's in that store. He has built the operating procedures. He has a 10-year track record. You have a personal guarantee from him. And that's the interesting thing going on in retail today, right? Everyone wants to talk about credit, but they don't give that any value for someone that's worth $15-20 million, who is the operator doing the sales that they're doing. We see that as very high credit, versus some saying you need the Jersey Mike's credit. We would argue which one of those is better, if not equal.
Right. I'm shocked. I had no idea you had that many national tenants in your buildings. How do you go find them, or do they find you?
Both.
Okay.
Both.
So you're really embracing the brokerage community, or you're going direct too, I'm sure.
No, I mean, we have third-party brokers on. We have an internal leasing team
Sure.
that creates the merchandising strategies, are responsible for the execution of those. But we have, we have third-party teams on the ground helping us execute those strategies. So the internal team is creating the strategies. Oftentimes we're doing portfolio reviews. We have direct relationships that we can utilize to get people interested in our centers that maybe weren't looking at the time. But all of that is through our brokers on the ground.
Gotcha. You've got some serious growth you're looking at. And, so do you have a fund behind you, or do you guys raise a fund, or are you syndicating each one of these deals? How are you guys doing?
No, we do everything through funds.
Okay.
So we are at the tail end of placing our second fund in the series.
Okay.
And we will be moving to raise our third fund in the back half of this year.
Yeah. How big is your fund you're raising right now?
We're going to put the final numbers on it. It'll be, plus or minus 300 million.
Okay. So you're raising funds and you're out there trying to broker. How are you sourcing deals right now? Through the brokerage community? Or are you guys at that size where people are calling you up going, say, hey, Ryan, I've got this property for sale. Do you want it?
Yeah, I would say both, but everything goes through brokers. I mean, the brokers have the relationship. They know the market. The ownership of this particular asset class is so opaque, right? It's not a public REIT, right? It's that one individual that owns that one asset. And so the brokerage community has that relationship, oftentimes with the property manager or the leasing agent for that. So we've got a 6-person acquisition team in addition to myself and, David Birdsall, the co-founder, and my partner, that, it's kind of organized chaos and how we how we cover the markets
Sure.
and get into the markets, stay top of mind with all the brokers. But the acquisition team is at the end of the day looking at thousands of deals per year. I don't claim we're underwriting every one of those,
Right,
but
sure.
we are touching and looking into a vast amount of deals, which honestly is the most difficult part of the strategy. It's just the volume and the size of the assets.
Sure. So your growth strategy, are you mostly focusing on Midwest to the East, or how are you guys, what's your growth strategy look like?
Yeah, I mean, right now, really, we are 75% Sun Belt. Anything from Phoenix down into Texas, into the Southeast, up through the Carolinas. That is, we're in almost every major market you would expect in that stretch I just laid out. And 25% of our portfolio are in select Midwest markets. We're in the Midwest. We're proud to be here. We think there's a lot of value and opportunity here. So we own in markets like Columbus, Cincinnati, Indianapolis, and are looking to expand. Well, I think that ratio will probably stay the same. That's not a hard and fast. We don't want it to be 75-25.
Right.
We probably will start to look in other markets like the Northeast and the West and the Pacific Northwest. Really, it's just been about capacity to date that's kind of kept us to those markets.
Yeah. Well, you're close to home. I just read something this morning, I think in Morning Brew, that Ohio is the 7th largest economy in the United States. I had no idea.
Surprised.
I'll have to check Twitter on that. I could be lying to you. Let me make sure. But how did you, I mean, where are you seeing, what states are you seeing the most growth right now?
I would tell you when it comes to rental rates, if that's our definition of growth, we are absolutely seeing it in those Sun Belt states. And really, we're seeing it pretty squarely across the board. I mean, we're running at leasing spreads that I would tell you are higher than what we're seeing in the Midwest.
Okay. All right. So yeah, it said, did you know Ohio has the 7th largest U.S. economy, and that ranks number 5 among the top states for doing business?
That's good to know.
Yeah. You landed in a great spot.
Certainly should be part of our investment committee.
Yeah. Well, I just do a little reading before I show up. So now I forgot the question I was going to ask you. Retail. What are you guys seeing in retail right now? Is it staying strong? Reading so many different stories out there about retail is still hot, retail is still slow. What are you guys seeing in your centers?
It is incredibly strong.
Yeah.
And I don't think I need to get too deep into what's driving it, but at the end of the day, retail went through a recession in 2018, 2017, 18, 19, right? I mean, Amazon buys Whole Foods. We're all pretty sure we'll never go into a store again. So there was a lot of disruption, especially in the big boxes. Then COVID happened, and then we were 100% sure we were never going into a store again. And now we're here today, and clearly brick and mortar is a critical part of the supply chain, the brand experience. But, we're at all-time lows in vacancy. Demand for our centers is no longer traditional retail. I mean, what is the definition of retail? It's the dentist, it's the urgent care, it's therapy, it's things that used to go to a hospital or an office park for. So any tenant that has a model where they want to be close to the consumer in a more convenient location are looking at these, at these strip centers in the corridors that we're looking to acquire. So I would say just because some of the market and capital markets disruption we've all seen, right, has some leasing pulled back a little bit, but it's pulled back from A+ to A.
Right.
But capital has, at least capital costs have risen, certainly, since COVID, but we're starting to see that flatten in some cases even come down a little bit. So we're fundamentally, we're really happy with where everything sits.
Now, are you getting your debt from banks? Is that where most of your stuff is coming from?
Yeah, I mean, we've got, deep relationship banks, but, we increasingly so are using life companies and even credit unions.
Yeah. I want to go back to something you were saying is the e-commerce. We're all, oh, retail is dead, e-commerce, everything's going to be online. And I think now that's reversed so much that now e-commerce is driving more people to brick and mortar. And do you see, or are you guys projecting any changes down the road for that? What e-commerce is going to be affecting?
We don't. And I mean, you've seen e-commerce sales as a percentage of total really flatline.
Yeah.
It's clear that brick and mortar is a key part of the supply chain. If anything, at least in the markets, the suburbs and the markets and the corridors we're acquiring in, the other trend people aren't talking enough about is, retailers are downsizing. So they may be expanding, but they're looking at how they can use brick and mortar more productively. But two, they're looking at how they can get into better locations, convenient to the consumer, which means that they can't just be in a 20,000 square foot box or an 8,000. They're all trying to figure out how to get smaller formats, cost cutting and productivity,
Sure.
really to improve their locations to get closer to the consumer.
Ryan, that's spot on, because the last week we had two local retailers that are wanting to downsize. They're in 4,000 square feet, and they called and were asking about kiosks in some of the local malls.
Right.
And they're like, listen, we can downsize, we can put all this in a kiosk. Now the kiosk is, the ones they wanted were 10 by 15, I think. So not tiny, but still compared to what they're in before, they're just going to have what was really selling in those kiosks. So yeah, I think you're right on point. Is the retailers willing to take a smaller location? How's insurance affecting you guys? I mean, it's really, we're seeing it with some investors. They're like, man, this is really starting to hurt. What are you guys seeing in your markets?
Yeah, it's become brutal. I
Yeah.
mean, it's a major part of the underwriting. We're lucky enough, to have a diverse portfolio, so we can lean into the scale of our portfolio outside of those high cost areas, right? Up and down the coast predominantly. But we also have a mandate that we don't want a large percentage of any one of our funds to be concentrated to one area. That's not just simply the coast or the high insurance areas. So, we have to look at it, and you have to look at it in terms of, as we know, retailers can only, it still is based on the sales they're producing out of that location, needs to support the rent that they're paying. Now, brilliantly, the great retailers and the great users of our space are actually producing sales outside of the four walls, right? Old retail, everything had to be produced inside.
Yeah.
Retail or service or medical, right? The reason they can generate so many sales is that they're not fulfilling everything, or you don't have to come in, kind of take fitness. It's one of the challenges of some fitness concepts is that you are limited, right? You can only have so many classes and so many people in your four walls, versus someone that makes sandwiches or crumble cookie can fulfill, it's almost a commissary where they can fulfill 1 million sandwiches. And where it's actually originated, whether it's on your phone or at home or through DoorDash, doesn't matter, and it just comes. So the amount of sales are typically being generated far outside, those four
Brick and mortar. Yeah. Yeah, it just seems like we've all gotten a little bit smarter. I think AI is going to be another big evolution that we're all trying to figure out right now. How do you see AI affecting your business?
TBD, right? I mean, right now, we use a decent amount of AI internally, right? And
Sure.
a lot of it's in test mode for us.
Yeah.
Is it something you can rely on? How accurate is it? Is it helping with efficiency right now? So I'm not sure I'm ready to put a flag out there on how things are changing, nor do I claim to be the expert on that, but we're monitoring the best we can.
Yeah, we're kind of the same way in commercial real estate and the brokerage side of it. There's not a week that goes by that I don't get a call or an email from this new AI company that's going to change commercial real estate. So I've been testing a lot of it. Honestly, a lot of it I'm pretty amazed with, but some of it just not ready, But I do think in our commercial brokerage, you're going to see a huge evolution coming in the next couple of years. Some of this stuff has been amazing.
We're huge on R&D. I mean, I don't,
Yeah.
if you're not trying to innovate,
Yeah.
every, and what is the definition of innovation? Really, it's just trying things, right? It's just
Yeah.
keeping an open mind, trying to become more efficient, trying to get better access to information that allows you to make better real-time decisions. We've tried a ton of things, from our leasing team to our asset management team to our acquisition team. Certain things stick, certain things don't, but we've got a budget for it.
Yeah. What, because this is kind of a sticky question. So if I'm a investor and I'm going to buy a strip center and somewhere else, then I kind of want to know what I should be asking. What should my team be asking the property management company if I'm buying in Utah? How are you vetting this property management company out? Just through experience, reviews?
I will tell you, the best property managers that we have come across,
Yeah.
they can be found in-house at a major brokerage, at a mid-sized brokerage, or they can be a smaller brokerage attached to an existing developer.
Yeah.
The common thread that we have found is that they own or have owned their own properties,
Yep.
where they were forced to think of it like an owner.
Yeah.
Right, themselves, that at some point they created processes on how often sidewalks should be cleaned, or dumpsters. I mean, all the way down to the dumpster. I mean, we have literally processes and protocols on how often we want that done, just around kind of our own standards. It has been very difficult for us to get that across, or have a working relationship with anyone that hasn't actually owned themselves.
Yeah, the process is that structure is key. Now, how often does your property management go out and walk the properties?
Yeah, so we are very out there depending on the asset, because we've got different types of assets, right? I mean, you've got assets. I'll just speak about assets where, we've already completed the value creation, it's painted, it's fully leased, right? But I mean, the actual property manager will be out there, at least once or twice per month. But then we have, between our asset management team, the on-ground leasing teams, and our locals, there's typically someone there every single week.
Yeah, you about have to, right? Because we own some multifamily in Texas. We brought in a property management company, local. They own properties right in the area. And so we brought them on, and day two, they didn't know I was in from California. So I go walking out there. There's nobody on our property. So I go in, see the assistant manager, go, where is everybody? She goes, she just went white. It turns out we were paying them, but they were down working on the neighboring property that the other guys own. So boots on the ground are so important. That's why I wanted to ask that, because I think that company made it with us for 3 days. Then we started our own property management firm. I had spent a lot more time in Texas, which I thoroughly enjoyed. So that wasn't too bad.
Right.
But yeah, you've got to, when you talk about, when I hear passive investing, I just kind of cringe a little bit. If you're an investor, there's nothing passive about it. You need to be watching your investment. It sounds like you guys do that. You're there that much. That's huge.
You have to. I mean, when people hear funds, when we launched Last Mile, it was around strong investment thesis, which is, we believe there are macro tailwinds behind the unanchored retail space that will create outsized returns. Mm-hmm. Then the second layer is selecting the right asset and having the right sourcing strategies. But third, what many people forget about is the operations, is the actual value. Because if you get those first two right in this space, you'll generate, right, some level of alpha. But to get that true outsized return, or to be honest, make sure that it's also a defensive investment, you need that on the ground. And really, we made a big decision on whether we should internalize property management or not, and we love those people on the ground. So it's also why, right, we have property management people internally. We have leasing people internally. They are responsible for the execution of all of our plans, the day-to-day property management, the cleanliness of our centers, the merchandising of our centers, and then they're using those people on the ground to make sure that we have those boots on the ground on a regular basis. That would be difficult to achieve without.
Yeah, I mean, you want to be out there. You want to go in there and talking to your tenants too. You know, you don't just want to put them in there and then not see them again until their lease is up. You want to be hearing what's going on in your center and, you know, how you can make it better for them. And, you know, then when you have a vacancy, it's a little easier because if you've treated them well, they're going to want their to be able to pick their neighbor. So that's huge.
So
Go ahead.
relationships, and I would tell you, it's beyond just simply good relations or renewal strategies of your tenants. These are amazing operators, and they typically have multiple units. And so we go back to the Jersey Mike's guy. I cannot tell you how many times we built a relationship with that guy. He's seen how we operate assets. He's seen how we care for the center, that we invest, right? So everybody can grow together. And next thing you know, he's coming to us saying, because of the lack of vacancy out there, here are the 3 next areas I want to get into. Can you go look at these 3 centers I want to be in, but I need them to be run differently than the way they're being run today. So those tenant relationships are looking a lot more like partnerships today. And a lot of it, there's the lack of vacancy, right? They don't know how to get into some of these corridors. And then looking up and down a lot of these great corridors, there's a lot of strip retail that is just underinvested. And it's because it's clipping a coupon. They don't need to put money into it, but there's an opportunity to start bringing in that next tier of merchandising and center. And a lot of those discussions are starting with their tenants.
Right. Absolutely. You know, there's a tweet that was put out recently and it said your top, and this one, I saw it everywhere. It was put on Twitter. Strip mall guy put it out. He goes, the top 10 tenants you want. One, I think, was dentist, and the last was a karate school or something like that. And man, I saw that post. So this is how I knew strip mall centers were a hot topic. I saw that post on every platform, completely redone. And I thought, man, there was a lot of power in that. So now, outside of price and location, Ryan, what other metrics do you look at when acquiring a property?
So for those that are close to the tenants, we literally mimic what the top tenants are looking for. Now, sometimes we need to educate them, because what do tenants do, right? They typically will start with the 5 no-brainers. Hey, if I'm entering a new market, here are the 5, 3, 4, 5, 10, depending on the size of the market. But look, we're 100% suburban. We are looking for the more desirable suburbs of that, particular MSA. And then we're looking for those corridors that are already being frequented on a daily basis from the consumers that are captive within the 1 and 3 miles. So what are those corridors? They tend to be the most trafficked thoroughfares that have the grocery store, that have the Target, that have the hospital system, that have the TJ Maxx. And sometimes they have that times 10, all of it on one corridor. And we're buying those little centers up on the curb, typically right next to those demand drivers, at the end of the day. Beyond that, when we get down to the actual asset, once we've identified the market, the suburb, and then we've identified the areas and the corridors that we want to be in, we get down to something we call Vista. And Vista for us is visibility, intersection, signage, traffic, and access. Okay. And we have a rating for each individual asset to help us give us some clarity around those. And those are more important than people think.
Do you ever do a 2-story strip center?
Very rarely. I can't tell you we haven't, and I can't tell you we won't again, but it requires an A+ situation and a correct underwriting for that scenario.
It's got to be hard to lease out that top floor, isn't it?
Terrible.
Yeah.
I mean, it is one of the beauties of appropriately located convenience retail is that it's not a commodity. Right. It is an absolute 2,000 square foot space that high paying tenant needs to have. That is scarcity, that is supply and demand. That second story turns it into a commodity. You are a taker. What tenant wants it, and what rent are they willing to pay? Right. And there are some unique situations that we have built the perspective that that's not true, but very, very rarely. I mean, look at all the real estate today that's, mid-block in the wrong part of the corridor,
Yeah.
that's commodity. So what is market rent for that center? Is it 12? Is it 18? I don't know. It's whoever shows up on that day and is willing to lease your space, right? And we're just not investors in commodity retail.
Yeah, it's tough. I learned a lesson, actually a hard lesson, bought a 3-story walk-up 6-unit building. You know how hard it was to keep that top 2 units leased. Nobody wanted to carry groceries up those steps. So I learned
Talk
the hard
about being
way.
in your asset daily, right?
Oh, you have no idea. That was, I came off being a genius. So we had a property we had a home run with. So we
Nice.
took that money and bought a couple other properties, and this was one of them. And it sure knocked the genius right out of you. You're like, okay, that wasn't smart. We ended up getting out of it and did okay, but we got very lucky. So now ingress and egress on your properties, there's got to be something specific. Do you worry about trucks? What all do you worry about for ingress and egress? Because I'm seeing some properties around LA. I'm like, man, that property's hard to get into.
Yeah. I mean, ultimately, if it's hard to get into because of traffic, we like that, right?
Yeah.
It's, hey, my parking lot's full. Well, your tenants are crushing it. It's a good problem to have. Now, if it's full because it's tiny and you can't get F&B in there and start improving your merchandising. But look, we're all relative. So yeah, do we want access from all ways? Do we want to be at a hard intersection? Do we just want to be right in, right out? No. But take Florida and the median situation, right? If we're in the right location, next to the right grocer or demand gravity drivers, we like to call them, and we are like everyone else, meaning no one else has an advantage over us in that, then we'll look at some access that might be a little inferior to 95% of our portfolio. Now, the reverse is true as well. When we find an asset, we own an asset in Jupiter, Florida, right on Indiantown Road, at a light, where everybody else has got the median situation. And again, talking about buying into scarcity and non-commodity retail that has, high demand, it can be a big game changer if you have it and others don't, for sure.
Yeah. I want to talk about this median thing because a lot of people that aren't sophisticated in investing might get tripped up on this. So if you have a median, you're getting one-way traffic, right?
Correct.
They're going to have to go down on the other side, or going to have to go down, do a U-turn and come back. And that cuts the likelihood of them. And I'm sure you probably know the percentage of them actually coming in and utilizing your stores.
Correct. And so it's very difficult for us to get over that. There are some markets, like they call it the Michigan left, or the medians in Florida. The other thing you have to look for as well is typically those type of corridors have cars traveling 50 to 60 mile an hour anyways.
Right.
So if you're mid-block with bad access on a road that typically is commuter at 60 mile an hour, that can be really tough retail.
They're not even looking, so there's two things I want to really get, because I don't know how much time you have, but signage and parking lot, how important are they? Or a good parking lot?
Huge.
Yeah.
Huge. I mean, signage, we have an asset we're acquiring right now, and the value add strategy was all around getting new local approvals for a new sign. We did not feel like that asset had any upside without a new sign.
Right.
And I would tell you, as tough as municipalities have become on even things like just a standard lease, and that has actually gotten a little bit out of hand. This was an interesting scenario where the municipality and the local government was actually excited that we were bringing in an investment, and we actually got far more in signage because we were willing to come in with a plan and an investment plan. But signage, people want to talk about visibility and facade, but they rarely want to talk about signage. It's easily in our top 2. It's a game changer. Parking lot, the same. I mean, you need to have, and if you don't take into account, we see the parking lot as an aesthetic as well, right? There's a pleasing attribute to coming up to clean, updated, but overall, right, you need to have the ample amount of parking to be able to drive the rental growth. So if you think you're going to bring in all this F&B, right? And you're not used to looking at the zoning or the restrictions, what's going to be needed, you might be stuck, at the same rents for the next 10 years.
Yeah. And to go back to signage, a Subway or any of those places aren't going to come in if they can't have signage, or
Yep.
good signage. They want to know the traffic count, foot traffic, and all that. So now on your properties, do you blend into the area with the look of your property? Or do you guys have a brand that you like this is our brand, this is the way we're going to make this property look?
Yeah, I mean, we will do both. Sometimes you're forced into blending in, right? There are approvals or color palettes you need to stay in.
Yeah, associations could dictate that.
Correct. If not, we will certainly try to make it stand out. That doesn't mean make it wild and bright, but we've got paint schemes with awnings packages, with lighting packages, with niche-ha, with landscaping that almost gives it a design sense, right? Everyone wants to talk about it just paint. We've got 4 or 5 different really kind of designs. Every deal we look at, and I'm sure later on in 2 years we'll have 10 and we'll have 12.
Sure.
We rarely will acquire a deal that doesn't have some type of aesthetic upgrade plan.
Well, Ryan, this gonna be my last question. So what are you most excited about with the investment in strip centers right now? Where's the opportunity?
What I am most excited about, we've talked about the operations and the leasing demand. The fact that we are very much in the early innings of this as a real asset class. What's it even called, right? We like to conveniently call it last mile retail. There's convenience retail, there's essential retail. And, there's going to be a growing amount of players in the space. There's multiple ways to play the overall space. But at the end of the day, there's something around 70,000 of these centers across the country, almost 1 billion square feet. And when you compare that to grocery, there are far less, but there are thousands of people with significant allocations to grocery and hundreds, if not thousands, of grocery platforms. So when you think about this asset class, and there being far more of these centers, and maybe only 1% of them are actually owned by a platform like ours or others, that are out there, there's a significant opportunity. I do believe you need to focus on it. It can't be a partial. I mean, just the granularity and the size and the volume of the strategy, it's easy for it to eat you if it's not something the entire platform rallies around, creates processes around. But I think the early innings of the opportunity and how fragmented the asset class is outside of what we've already talked about, what I'm most excited about.
Well, I don't think, and I'd like to get your opinion, I guess. So one more question is I don't think institutional, are they going to get into it? Do you think? Or, the big institutions?
I do. I mean, I think it's already being seen as an asset class with durable cash flow. Forget for a second the tremendous growth opportunity within those cash flows. Okay. But retail in general, there's a new light on it institutionally. I mean, literally 3 years ago, no discussion, very little discussion, maybe outside of pure play grocery, or if you can get them opportunistic returns. Today, because of the fundamentals behind retail, there is an increasing amount of discussion around it, for sure. Yeah. And think about this particular strategy. It'd be very difficult for most institutions to actually engage in it directly. Think about single family rental, think about storage. There's an opportunity in actually building the right portfolio of it. But the fundamentals at this point are pretty undeniable. Whether there's a space for it in any given institution, right? Whether they're full on retail or not will be the question on whether they look at it. But the interest in it, in retail in general, is absolutely coming back into light.
Well, let's hope BlackRock and Blackstone aren't watching this video. You might have just started something.
No doubt.
I doubt they're watching us, but
Just like it to stay
anyway.
away for a little longer, a little longer.
Yeah, well, they probably they'd be more interested in anchored, I think, wouldn't they? Want that big old anchor tenant too, probably, but you don't know.
Yeah, I mean, I think the anchored real estate's nice.
Mhm.
For one large reason, it's just a chunkier investment, right? It's not, it's a much more efficient investment for an institution to be making investments 50 million, 100 million, 200 million. Shoot, some institutions have got large enough, that's not even large enough. So I think this asset class is something that they fundamentally think is probably a strong thesis. But the big questions around how to access it and how to get exposure to it.
Well, it's something I want to be watching, and good luck to you guys. I think it's you're on a tear, and it looks like things are going great.
Joe, I appreciate you having me.
I appreciate you coming on, Ryan. Let's get an update here in the next several months and see how many states you're actually, or how many markets you're actually in, so we can
Let's do it.
keep an eye on you. I'm going
Follow
to put your
up.
contact information down below so anybody can reach out to you with further questions. And if anybody has any questions you want to put in the comments, we'd be happy to answer them. I'll make sure that Ryan sees them. And if you haven't done so, make sure you give us a like. And also, if you could give us a subscribe. I can't talk. All right. Thank you, everybody.
Appreciate it.